Thank you very much for that very kind and generous introduction, CA Haridas Bhatji, convener of JB Nagar CP Study Circle, CA Seema Mehta, Deputy Convener CA Krishna Kediaji, WIRC Regional Member CA Manish Gadiaji, my very esteemed friend, past council member of our institute, past chairman of WIRC, and more important, I should say, a person who has done an astounding work as a chairman of the Accounting Standards Board, CA Sanjeev Maheshwari ji. And thanks to you, Sanjeev bhai, that we have this opportunity of meeting again in the JB Nagar CP study circle. I recall during my presidentship, we had I had the occasion to visit in a physical meeting as it used to be in those good old days in 2015-16. But thanks to you, I have this opportunity of meeting members again in the JB Nagar CP study circle, if not physically, virtually. So my deep sense of gratitude to Sanjeev bhai and convener, deputy convener and all others for giving this wonderful opportunity. I'm very impressed by that code of ethics, the way you start your study circle meetings, Manish ji. It's a very good initiative of Western India Regional Council. And there can be no better way to start a discussion on academic issues, just reminding us about the important aspects of code of ethics. And the video that you show would certainly have a better impact, because many a times what goes in the print media may get overlooked, but when it is there before you, before your eyes in the electronic media in the form of a video, it certainly has a much better impact. So it's a great initiative on behalf of the WIRC. Friends, the topic given to me is a very general topic, and it is in the sense audit of private limited companies and audit of tax audits is something which is bread and butter for majority of us. Discussing the issues arising from auditing companies and income tax audits, I've tried to stitch together some of the important aspects about auditing, standards on auditing, and correlating them with certain practical aspects regarding the audits in companies and in case of audits under Section 44EB of the Income Tax Act. As of today, most of us would be preoccupied with the audits of companies and the income tax audits because given the pandemic situation, things have been delayed. And in the month of October, Sanjay bhai mentioned that this would be an appropriate topic to discuss. So with that, I would start with my presentation on this subject. Madam, I hope the presentation is visible. Yes. And during the course of discussions, if by chance there is a audibility issue or the presentation is not visible, please do let me know.
Yeah, sure.
So friends, when we talk about auditing, it is said that audit is audit is audit. So whether we are auditing a large listed company or a small educational institution, we are guided by our standards on auditing. As you are well aware, friends, since 1984-85, when the tax audits first came into the statute, Section 44AB of the Income Tax Act, there has been a great demand from other professionals that they should be also allowed to do the tax audits. And it is important for us to remind ourselves that while we respect all professionals for their tax knowledge, the income tax practitioners, income tax advocates would certainly have great depth of knowledge on taxation laws. But what really is the domain of chartered accountants, exclusive domain of chartered accountants, is audit. And this is one aspect which the institute brings it to the notice of the government, regulators, and all concerned, that while others have knowledge on tax, the knowledge on audit, which is important, is with the chartered accountants. And rightly so. We are following a very rigid code of ethics, as we just had, how to communicate with the previous auditor, how to wait till such time he responds, so on, so many things. We follow a very rigid code of ethics. And in some cases, I would say the Institute's code of ethics is even more rigid than what is there at the international level. So while we have adopted recently the International Ethical Standards Board, IFAC, ISBA 2019 Code of Ethics, in many ways, our code of ethics, our principles have been far more rigid, which we as an institute, as a profession have been following since 1949. Now, given that background, what is it that the institute is telling the government, and what is it that we are saying when we issue an audit report? So that is why I thought this basis for opinion is something what should be the starting point for today's discussion. SA 700, all of us are well aware. We emphasize that we have carried out an audit based on standards on auditing as specified under section 143.10, now that they are part of the Companies Act. In case of non-corporate entities, these are the standards which we say which have been issued by the Institute of Chartered Accountants of India. And our assurance to the readers of the audit report is that we have complied with the applicable auditing standards as issued by the institute, and in case of companies as notified under the Companies Act under subsection 10 of section 143 of the Companies Act. Now that is the assurance which our audit report is communicating. And that is important for us to bear in mind, that whether it is an audit of a large listed company like a large listed bank or a multinational corporation, or maybe it is an audit of an educational institution, a charitable trust, or a housing society, which is so common in the city of Mumbai, it is all these auditing standards become applicable. And we need to ensure compliance with these all auditing standards. Now, these are today in the form of how these auditing standards are structured. If you just look at this flow chart, standards on quality control, as we call it, SQCs, that is at the right at the top. At the apex in the pyramid will of course be the Chartered Accountants Act, then the rules, then the regulations, and these are the standards which are applicable to us. So the SQCs are divided into two parts: assurance services and related services. In the assurance services, we have a framework for assurance engagements. And then we have this audit and review of historical financial information, assurance engagements other than audit or review of historical financial information. And within the audit and review, we have then the standards on auditing and standards on review engagements. So if you are auditing a listed company, and today in month of October, many of us would be occupied with the half-yearly, quarterly results, then we are guided by standards on review engagements. Review engagements give a negative assurance that nothing has come to our knowledge, that no material misstatement has come to our knowledge. So it is a negative assurance. In an audit, which is a higher assurance, we give an audit opinion, and therefore we are guided by the standards on auditing. And audit, friends, is such a peculiar situation. It's a three-party relationship, tripartite relationship. The auditor, the auditee, and those who rely on the work done by the auditor. In a way, it is the auditee which appoints the auditor. The auditor issues an audit report on the financial statements prepared by the auditee, and it is then relied upon by all others who are not even privy to that contract. But today, under the Companies Act, as we are aware, there can be class action suits against auditors. There are stringent penalties. Thankfully, the Companies Amendment Act 2020 has reduced the burden of penalties, and the penalties are moving in a right direction. I would say we are grateful. We have two past presidents of our institute who are members of the current committee. The thought process is that if there is a procedural mistake, it should not lead to a criminal action. And if there is a criminal intent, if somebody has cheated the investors, somebody has cheated the stakeholders, then be it an auditor, director, whosoever has cheated should be stringently punished. We are all on the same page as far as that is concerned.
But other punishments for procedural lapses should not be so cumbersome, should not be so high. And that is the intent of the Companies Amendment Act 2020. When any issue on auditing would come up, whether any issue comes up with respect to how the auditor has discharged its duties, these standards on auditing become our defense, whether it is an income tax audit, a private limited company audit, or the housing society audits and so many other audits which we are normally doing. And friends, my experience has been that the audit of charitable institutions, audit of housing societies are those audits which are generally done by many of us as a service, as helping somebody who is doing otherwise a good job. It is not done with the intent of earning profits out of that assignment. But whatever be our intent, if there is any mistake in a housing society audit, we know the auditors can be held up and the institute takes action. So in that context, we need to be guided by our standards on auditing. And these are the standards on auditing, as all of us are aware of. I believe all of us comply with the requirements of the standards on auditing on all the occasions. And therefore, in a positive sense, we need to discuss the issues arising from these auditing standards and how best we can still ensure compliance with our audit when we are doing an audit under the Income Tax Act or under the companies, private limited companies, which is the focus for our discussion. Friends, I would also say that people like Sanjeev and myself, we have passed sometime in 1980s, and many of the members present here would have passed around that time. Those who have passed in last 10 years would have read all these standards when they appeared for exams. And in that sense, those who have passed in last 10 years are well aware, better aware, I would say, about the requirements of the auditing. When I passed, we did not have accounting standards, hardly one or two accounting standards. We did not have so many standards on auditing. And today, the concept of audit under the standards on auditing has completely changed as what we were doing in the good old days compared to what we are required to do today. And that would be the starting point for today's discussion. This is one guide which has been issued by the Auditing and Assurance Standard Board. This is available on the Institute's website. Practitioner's Guide to Audit of Small Entities. Friends, if you ask me today, we can put the audits which we are doing into two buckets. Audits which are today, whether we like it or not, and certainly people like Sanjeev Bhai and myself don't like it, but those audits which are today governed by NAFRA, NFRA. So NFRA is part of the law, and NFRA has been given certain mandate under the Companies Act. The government of India has notified NFRA. So as good citizens of the country, we have a duty to ensure proper compliance with the directions of National Financial Reporting Authority. And NFRA has brought in and has issued draft rules as to how the audit documentation is required to be presented to NFRA. So I would say that is one category of audits. Audits of listed companies, audits of banks, insurance, and other such entities which are so as to be called as public interest entities. And other category is audit of small entities. So today what I'm focusing is audit of smaller entities. We are talking about compliance with the accounting standards, not Ind AS. We are talking about compliance with Schedule 3 to the Companies Act Part A. And we are talking about those audits which are really not public interest entities, but those audits which are still audits, which are important audits, and in compliance with the auditing requirements related to those audits. This is one very good publication which the Auditing and Assurance Standard Board of our institute has issued, which is available on our website. And I would request members to download this guide, and this would enable us to carry out our documentation work in a more effective manner. So I'm not going through the various aspects of this guide, but this I found to be a very useful guide when we are talking about audit of smaller entities. Of course, audit of listed entities will today have to follow what is being issued by NFRA, and they will have to be complied with. Now, friends, an audit opinion which is issued by us and which is guided by SA 700, 705, 706. If I can put it in this pictorial chart, it would be an audit opinion could be classified into two categories, an unmodified opinion, and second is what is a modified opinion. Unmodified opinion is a clean report where we are giving an assurance with respect to which no modification is required and everything has been complied with by the auditing, and therefore we are issuing a clean report. Most of the times, most of us are issuing clean reports, and that is what is guided by SA 700. Then we come to modified opinions. And modified opinions could then be put into two categories: modification which is affecting the opinion and modification which is not affecting the audit opinion. Insofar as modification not affecting the audit opinion is concerned, it is emphasis of matter, and emphasis of matter is guided by SA 706. Modification affecting the audit opinion could be a qualified opinion, adverse opinion, or a disclaimer of an opinion, and that is guided by SA 705. And then we have key audit matters under 701, 710, which is with respect to comparatives, and 720, which is with respect to other information contained in the annual report. Now, friends, I have one slide later on when we discuss with respect to tax audits, how these modifications affecting the audit opinion, modifications not affecting the audit opinion would apply in context of a income tax audit under form 3CB or 3CA or 3CB, which we are issuing, where the particulars are being issued in form 3CD. So we'll come to this slide again when we discuss the practical implication of issuing an audit opinion in context of a tax audit. 705 says the modification of an opinion, and this is one very nice table which is given in the application guidance in 705. And it says when do you give a qualified opinion, when do you give an adverse opinion, and when you disclaim from giving an opinion. So there are two types of situations. Financial statements are materially misstated, and it is material but not pervasive. And second is it is material and pervasive. So if it is material but not pervasive, we give a qualified opinion. If it is material and pervasive, and there is a material misstatement in the financial statements, the materiality is there and it is pervasive, then we are giving an adverse opinion. And if the auditor is unable to obtain sufficient appropriate audit evidence, which could happen in a situation like a pandemic situation in which we are living, and if it is material but not pervasive, we still give a qualified opinion. But if it is material and pervasive and we are unable to obtain opinions, then we are required to give a disclaimer of an opinion. So this is the sum and substance of the 705, so to say, with respect to when a qualification is required, when an adverse opinion is required, when a disclaimer is required. Earlier, friends, we had statement on qualification in auditor's report. And that statement had certain very good examples also. But after the standards on auditing were issued, the statement on qualifications in auditor's report was withdrawn. And therefore, that guidance is also not available today. And the guidance there was, if say there is a qualification which is resulting from profit to a loss. So a company having a turnover of say 100 crores, there is a material misstatement with respect to say inventory valuation, which is resulting into a profit of 5 crores converted into a loss of 5 crores. So there the guidance was that you cannot say that subject to this qualification, the balance sheet and profit and loss give a true and fair view. Because your qualification is so material and pervasive that it is converting a profit into a loss. And in such a situation, it is not right to say that subject to this qualification, the balance sheet shows a true and fair view. And therefore, the guidance was that you give an adverse opinion or you disclaim from giving that opinion. Now that we have 705, we need to apply our risk assessments, our levels of materiality, and then decide when to give a qualification, when to give an adverse, or when to give a disclaimer of opinion. So these are very subjective matters. And it is here that we need to take an appropriate decision. And equally important from the point of view of small and medium practitioners auditing small and medium entities is to document properly that decision which we have taken. Friends, as was just mentioned, I had the privilege of working in the International Federation of Accountants Small and Medium Practitioners Committee. And small and medium is nothing small in relation to the knowledge that the professional has. It is just in terms of the organizational size of the firm. And I found sitting and working in the IFAC committee that the problems which the small and medium practitioners which we face, say in a place like Indore where I come from, and in a larger city like Mumbai where the members are today, as compared to the problems which maybe people in developed economies are facing, the nature of problems are similar. The magnitude of problem could differ, but the type of problem is similar. And it is here that the institute's handholding, which we have in our institute, in our country, is very important, which helps us in discharging our duties. And we will refer to certain guidance notes as to how those guidance notes gives adequate guidance when we are required to discharge our professional duties. So these are two slides which on modification of opinions and audit opinions, which I'll take up again when we discuss the relevant aspects under tax audits. Now, friends, standards on auditing, when we say that we have issued our audit opinion in compliance with the standards on auditing. So, of course, the starting point of the audit will be what was discussed in Code of Ethics, that you communicate with the previous auditor. So that is a mandatory requirement under the Chartered Accountants Act. When we come to standards on auditing, more practically, I would say SA 315 should be the starting point. Even if it is a continuing assignment, the starting point is risk assessment. Because today we are talking about materiality, we are talking about sample audits, we are talking, and we have a huge responsibilities. If you look at tax audits with respect to tax deduction at source, there is a requirement whether all the items have been reported or not. Now, there is no way that any auditor can report all the items on which tax is required to be deducted has been deducted, and it has been incorporated in the tax deduction at source returns. So the institute's guidance note gives a disclaimer that it is done on a sample basis. We have relied on a sample. We have done on the basis of standards on auditing. And therefore, the starting point needs to be this SA 315 risk assessment. And then, of course, response to risk assessments, materiality, and forming our audit opinion would follow. One of the very key aspects in the today's circumstances is fraud, reporting obligations under a fraud. Subsection 12 of Section 143 of the Companies Act, which applies to a private company or to a public limited listed company, it applies to all corporate entities. It requires the auditor to report on a fraud which has occurred or which is occurring. Now, we are all used to the very famous English decision that auditor is a watchdog, auditor is not a bloodhound. Having said that, what is it that our auditing standards are requiring us to do in context of frauds? Are we required to detect frauds? Answer is no. Our obligation is not to detect frauds, but our obligation is also to consider whether a fraud could have been taken or whether a fraud could have been committed. And that becomes one of the key starting points even in SA 315 requirements. So let me go to SA 240, auditors' responsibilities relating to frauds in the financial statements. And friends, this is one paragraph 15 of SA 240, which whenever I read, I'm scared about doing an audit. And let us see what is this standard requiring us to do. SA 315 requires a discussion amongst the engagement team members and determination by the engagement partner of matters which are to be communicated to those team members not involved in the discussion. This discussion shall place particular emphasis on how and where the entity's financial statements may be susceptible to material misstatement due to fraud, including how fraud might occur. And the last sentence is very important. The discussion shall occur notwithstanding the engagement team members' belief that management and those charged with governance are honest and have integrity. Now, I genuinely believe my client is an honest person. He is complying with the laws, and I have no reasons to suspect that there is a fraud in those or financial statements. And that is the situation with 90% of our clients, if not more than that. So essentially, we are doing audits of honest people. But even then, the standard requires us, SA 240 requires us that before start of the audit, we need to have a discussion as to how a fraud can be committed. And this discussion has taken place, needs to be documented. Fortunately, we did not document all that could possibly happen in a fraud. But a proper discussion is important. If the client is honest, it does not mean that there cannot be mistakes, there cannot be frauds, which even the client is not aware of. And therefore, SA 240 would require us, even if it is a tax audit, even if it is a housing society audit, or an audit of a listed company, we need to have this kind of a discussion. And I can tell you, friends, if you really have this discussion, and I'm sure most of us do have such discussions, I'm sure you'll agree that there is a lot of value additions, and particularly the young members, youngsters, article trainings who are going out for audit, who are so enthusiastic about doing an actual audit. They can come back and give us more information about how an Excel sheet can be manipulated. And the knowledge which the students, youngsters have with respect to technology is far superior to knowledge which a member like me would have. So this discussion is very important, and documentation of this discussion is more important. So let us look at, in a typical company audit, a private limited company audit, where we are also doing a tax audit, what could be the risk areas which need to be considered. And this is an illustrative list which I have put up on this slide. Whether the sales has been properly accounted for in accordance with accounting standard 9 or Ind AS 115, as the case may be. So recognition of revenue and expenses are the most important part with respect to our, I think I'll have to change over, madam, just give me a second. There is some power problem. I may have to change over my net systems. Am I audible right now?
Yes, yes, you're on.
Okay, okay, okay.
Yeah.
So this is one illustrative checklist which I have put up for compliance with SA 315. So recognition of revenue or expenses, then physical verification of fixed assets, titles, verification of titles, because in CARO 16 and more so in CARO 20, this is going to be an important area for reporting. Verification of the fixed assets registers, confirming the balances from the general ledgers tally with the fixed assets registers, additions to fixed assets, depreciation calculations, verification of inventories, valuation of inventories, then confirmation of balances of debtors, creditors, and other advances, compliances with the tax deduction at source, because in income tax audit, I find this is one of the areas which takes a lot of time and which has so much of implications even with respect to disallowances under section 40A, that this becomes an important area for our verifications. Loans borrowed, because cash credit is a very is a area where there are non-compliances, there could be additions, and therefore we need to be careful. And whatever is the legal and regulatory requirement in CARO, in income computation disclosure standards, applicable NBFC guidelines of the Reserve Bank of India, whatever is the other requirements in Form 3CB. So these are generally the areas which most of us would identify as where we need to focus our time and attention, where we need to draw up our audit programs and see that substantive checking is done, so that we have controls identified and substantive testing done to give a proper opinion. So what are the risk areas, and then what is the materiality level is the one of the starting points which we should discuss and decide before we start off and kick off an audit. Now, let me take up some of the standards and what is the requirement of the standards and how they apply in context of a audit of a private company or in the audit of a non-corporate entity under Section 44AB. So one of the important standards which I find is SA 501, which puts in a lot of responsibility on the auditor with respect to two matters which I would like to discuss is inventory and litigations. Of course, SA 501 also covers segment information, but typically under AS 17, what we say is that the company has one single segment and then there is no further disclosures which are required. But inventory and litigations is something which is applicable in case of most of the audits, and there we need to be careful as to what is the reporting responsibility which we have, what is the audit responsibility which we have under SA 501. So to begin with respect to verification of inventory, physical verification of inventory. Now, why SA 501 is so important? And let me share some practical experiences which Sanjeev Bhai and myself we have encountered in the several disciplinary cases which we have seen in our council days. In case of a non-corporate entity, an audit is completed, audit report is filed. And I'm giving very live practical examples. The audit report is filed, the tax audit report is filed, uploaded as it is today. Earlier, the physical copy would be scanned and filed with the department. And in the week following that, there is a survey which takes place. Income tax department carries out a survey at that shop or that business premises where we have audited. And generally what happens in an income tax survey is that to avoid litigation, to buy peace, a surrender is done, and that surrender is of stock. Historically, the surveys would result in surrender of stocks, whereas last few years, because the tax rates have gone up so high, people are afraid of even surrendering stocks and they are litigating even with the survey teams. But historically, what would happen is that stock would be surrendered. And the survey team, what the survey team would do, the survey team would carry out a physical verification of the inventory, say on 10th of November, after the audit is completed. They will see what is the inventory, physical inventory on that day, and then make adjustments for purchases and sales from 1st of April to 10th of November. And then work backwards and say that on 31st of March, you should have had so much of stock. Your books are showing so much of stock. And the assessee, to avoid litigations, to buy peace, would surrender say 5 crores, 10 crores as unaccounted stock and get rid of this problem. Friends, what is our responsibility as an auditor? And today, even an assessing officer unfortunately has powers to impose penalties on chartered accountants, which I feel is very unfortunate position, because without understanding the and taking all that is required under the Chartered Accountants Act, as the way and manner assessee can be imposed a penalty, even a tax auditor can be imposed a penalty. And what is my responsibility then with respect to that stock which has been certified as part of the balance sheet? And if you look at what SA 501 is saying, and we have already said we have carried out the audit in accordance with standards on auditing. So 501 says, where inventory is material to financial statements, the auditor shall obtain sufficient appropriate audit evidence by way of ensuring the existence and condition of the inventory, by undertaking physical verification of the inventory, by participating in the inventory verification which the client has taken. Now, assuming in case of say a non-corporate entity, I am appointed today on say 11th of October as a tax auditor. The due date for filing of the return as of today is say 31st October. On 11th October, I say I have been appointed. I have not verified the inventory as of 31st of March because I was not a tax auditor at that point of time. I have spent time in communicating with the previous auditor. Another 1 week has gone by. I have started my audit on 20th of October. I did not have time to carry out the physical verification. Neither was I an auditor on 31st of March, and on 10th of October and 20th of October, I don't have time to carry out physical verification of the audit of the inventory. But SA 501 says that either you do it on the balance sheet date. If you are unable to do it on the balance sheet date, do it on some other date. And para 7 says, if for some reasons it is impracticable for us to carry out the physical verification, make a disclosure in the audit report. And that is what I would like to emphasize, friends. In case of most of the non-corporate entities, people who are in retail trade and manufacturing units where inventories are not properly recorded for whatever reasons, because as I said, we are auditing small and medium entities. Our clients are honest, but they have practical difficulties. But their practical difficulties should not result in our non-qualification of our requirements of standards on auditing. And in all such cases, I find we have that form 3CB, and I'll take you to that a little later. We need to make adequate disclosures. I have not been able to verify I have not been able to physically verify the inventory. Give a qualification. Nothing is going to happen to the SSE. If the SSE has been assessed every year at a particular GP rate, even this year you would be assessed at the same GP rate, and no heavens are going to fall in the income tax assessments merely because we have given this qualification. I think this is what we need to spread word more amongst our profession and thereby educate our SSEs that it is my duty to give this audit qualification. And even if I give this qualification, I can tomorrow protect your interest as a tax consultant in the tax assessment proceedings, which is a separate work by itself. But SA 501 is very rigid in its requirements with respect to verification of physical verification of the existence and conditions of the inventories. Today, the bankers, if you ask them, and we are very fortunate that Sanjay Bhai is a director, independent director on the largest bank in our country. The bankers say that we have given credit limits on the stocks. The stocks have been certified by the auditors. The auditors have not reported anything contrary in their audit reports. So why do you blame only we, the bankers, for the non-performing assets? And these are areas, friends, where even our profession has to shoulder the responsibilities. So as far as possible, make sure that our audit team is present for physical verification. And in a pandemic situation as we are today, where none of us could have physically verified on 31st of March, we should carry out audit procedures, alternate procedures, carry out physical verifications on some other dates, and record those findings, do a plus minus, and arrive at the balance sheet inventory. And if none of this is possible, because of time constraints, practical problems, staff not being available in the pandemic situation, and so many other things, make sure that we give proper disclosures in our audit report in case of non-corporate entities in relation to Form 3CB. Now, verification of inventory. CARO 2016 is also very specific with respect to certain comments which are required for inventories. And as we are aware, clause 2 says physical verification of inventory has been conducted at reasonable intervals by the management. And generally we give a clean report. So we should have documentation as to how many times, in our opinion, given the size and nature of business of the client, how many times he should have carried out the inventory verification, and if that is done, whether it was reasonable and whether proper procedures were followed as is required in detailed in our guidance note on CARO 2016. So not only that we should be present for physical verification, but when the management has carried out the physical verification, whether that is reasonable, whether proper instructions were given, and discrepancies, if any, have been properly attended to. So this is an important aspect even from reporting under CARO. Then the valuation is based on first in, first out, or weighted average, accounting standard 2, Ind AS 2, as well as ICDS 2. All these three standards recognize only these two methods, first in, first out or weighted average. Last in, first out today is no longer, I mean, for last 20 years, so to say, last in, first out is not recognized. It has to be either a first in, first out or weighted average. Then allocation of production overheads, which is required. And it is here that our AS2 and ICDS2 both are in sync. So far as allocation of production overheads is concerned, it is based on normal level of production. It is not based on actual level of production. If actual level of production is taken, we need to ensure that the actual level of production is approximate to the normal level of production. Now, what is the normal level of production? And how are we ascertaining and documenting what is the normal level of production? So these are aspects which we need to bear in mind. Then standard cost is permissible, both under AS, Ind AS as well as under ICDS. Standard cost is permissible. Insofar as ICDS is concerned, it also requires that if standard cost is considered as a method for allocation of production overheads, there is a disclosure which is required that standard cost approximates the actual cost. Now, a peculiar part about ICDS is income computation and disclosure standards are meant for computation. They are not meant for books of accounts. It was originally expected when ICDS was issued that the disclosure requirements will be structured in the income tax returns of the assessees. But now what we have is the disclosures are part of the tax audit report. It's a very interesting situation. And then as a disclosure in the tax audit report, we need to certify that the standard cost approximates the actual cost. Most of the cases, standard cost and actual cost will never be the same. There has to be some variations. You could have considered certain thing as standard cost at the beginning of the year. End of the year, the actual cost and standard cost will differ. So to the extent of that variations, whether the valuation of inventory has been adjusted or not, and what is the impact of that is required to be disclosed under ICDS. And then proper adjustments are required to be made in the computation of income at the time of filing of the return of income. So today the tax audit report and filing of the income tax return have been very closely clubbed together. We cannot but look into all other aspects when we are carrying out a tax audit. We need to look at the income tax returns, whether we are the income tax consultants or not. Will be required to have so much of information about the assessees, particularly in case of individuals, where we are saying whether they have forfeited any advance or not. And these are matters which we are reporting under tax audit report today in terms of section 56(2) clause 9 of the Income Tax Act. So therefore, it is not just books of accounts, but other records, verifications of other records will be important. And standard cost would require a disclosure to be made by the auditor, whether the standard cost and actual cost, whether it approximates the same or not. Then friends, because in an audit, we need to ensure compliance with accounting standards, and which is one of the fundamental things when we are carrying out an audit. If the inventories are, we say inventories are to be valued at cost or net realizable value, whichever is lower. Now, assuming in a pandemic situation, and this is more so in context of audit of 31st of March 2020, that the cost may be more and the return on the net realizable value could be lower. So there it is not AS2, but it is AS5, which requires specific disclosure if the cost or if the inventories are valued at net realizable value. This is one area where generally it is overlooked, that where the inventories are valued at NRV and not at cost, specific disclosure under AS5 is overlooked. And then if for some reasons in the next year it is written back, so assuming in year one your cost is 100, NRV is 90, and therefore you have valued it at 90, and next year if 90 becomes NRV becomes 105, and therefore what was written down to 190 is written back to 100. Now AS2 is silent on this. whether you can write back the inventories. Accounting standard 2 is silent. We get the guidance from AS5. AS5 says write back of inventories is also an item which requires specific disclosure. And therefore, we conclude that if it requires a specific disclosure, it is implied that AS2 permits write back of inventories. Fortunately, under Ind AS 2, this is specifically mentioned that write back of inventories is permissible. AS2 is silent, but we need to take guidance from AS5 that even write back of inventories is permissible because it requires a separate disclosure. Then friends, on inventories, another aspect which I would like to cover, which is applicable both in context of audits and ICDS. And therefore I thought while speaking on inventories, I should club up the relevant issues at one place. Where many of our clients today are dealing in shares. And therefore valuation of shares becomes an important aspect. AS 13 says that if it is a current investment, it is cost or NRV, whichever is lower, and it is a long-term investment, then it is at cost unless it is a other than temporary diminution in the value of investments. The wordings are very, very peculiar, friends, under AS 13. It says other than temporary diminution in value of investments, because otherwise it could have been said if there is a permanent diminution in the value of investments. But the standard AS 13 says other than temporary diminution in the value of investments, which means that if there is a long-term decline in the value of investments, then AS 13 says you write down the long-term investments to a value lower than its cost. Now, if we look at ICDS 2, ICDS 2 recognizes cost or NRV only in terms of listed securities and also those securities which are not only listed but which are regularly traded. So if it is a thinly traded security as is defined under the SEBI norms, then cost or NRV will not apply. Unless it is a regularly traded script, we can apply the principles of cost or NRV. Otherwise, for ICDS, it is only cost which is required to be considered. Another important difference between accounting standard 13 and the ICDS 8 is that AS 13 requires cost or NRV to be considered script by script, whereas under ICDS, it is to be considered at a portfolio level. So if I have, say, investments in 50 shares, equity shares, and I will take the cost or NRV of each share, total of the cost and total of the NRV. If my NRV at the aggregate level is more than cost, then ICDS says that you need to take it only at cost. So you are comparing at the aggregate level, at the portfolio level. Whereas under AS 13, what is required is to be seen is that cost or NRV is to be considered for each share individually. In fact, AS 13 has discarded aggregation at portfolio level, and it says the better treatment and better accounting is to consider script by script and not at the aggregate level. So these are very fine differences which we need to keep in mind with respect to AS 13 and ICDS, because ICDS now the adjustments required under ICDS are to be reported by us as tax auditors, and even the disclosures which are required to be made for computation of income are required to be given in the tax audit report. And purely from an audit point of view, if we are not the income tax client of the assessee, then we should have a proper management representation letter as to what are the computation policies which the assessee is going to follow, because we are disclosing those policies in our tax audit report, whereas the filing of the income tax return is being done by another tax consultant and it is being done after we have issued the tax audit report. So keeping that dynamics in mind, we need to have proper authenticated management representation letter indicating what are the tax computation policies which the assessee would be following. Of course, which are mandatory under the Income Tax Act, under the ICDS, the assessee does not have a choice. But wherever there is a choice, even under the ICDS, so those matters should be very clearly decided and should be available with us as tax auditors. Friends, moving ahead on SA 501, the second aspect which I'm taking up is litigation. And litigation, what is our responsibility as an auditor insofar as litigation is concerned? This is also have been a very grave matter in the profession for a long time. And we have seen that even large listed companies, I don't want to name any particular company, but it is available from the published financial statements that the companies are litigating with the departments, income tax department, central excise department, or any other government department. And the matters could be pending before the high courts, the matters could be pending before the Supreme Court. And the company says we are confident of winning the case and therefore no provision is required. And it is a reality that whenever there was a tax settlement scheme, whenever there was some such kind of schemes, many of these companies have opted to go in those schemes and have paid that tax dues and closed those litigations. Now, as auditors of general purpose financial statements, the auditors can be questioned how you have satisfied yourself for so many years that there was no provision required in the financial statements. Whereas suddenly when there is a tax settlement scheme and as there is a Vivad se Vishwas scheme which is ongoing today, how the company has opted to go for that Vivad se Vishwas scheme and paid those tax dues, whereas it has been saying that it is pending before tribunals and high courts and there are favorable decisions and no provisions required to be made. So 501, which talks about litigation, is important standard from the practical point of view. So the responsibility under 501, to summarize, is we need not be experts in those tax laws, and we certainly are not experts in all the laws which our entity is governed with. So our responsibility is inquire from the management, inquire from the legal counsels, as and have a written opinions of them on our record as to why they believe that the matter could be still decided in favor of the company and therefore no provision is required to be made. So 501 is requiring us to correspond directly with the tax advocates, tax consultants, other lawyers, and or it could be a litigations with respect to title of the land or settlement with some customers, suppliers, whatever is the nature of litigation. We need to have adequate evidence with us of having corresponded with those legal counsels, taken their opinion as to why they believe that no provision is required, or whatever provision in their opinion is required to be made in the financial statements. And if that is done, and tomorrow in a Vivad se Vishwas scheme, the company has gone in for settlement, then at least as an auditor, my responsibility is, my role is protected. So in fact, if you look at standards on auditing, they are our best defense in case of litigations. They are our best defense to protect ourselves from whatever inquiries can come to us as auditors. So it's a very simple requirement under 501 to communicate, to correspond with the legal counsels and take their opinions. Many of times we find situations where company has paid the money, so they don't expect any further cash outflows, but the amount is not debited to the profit and loss. And many promoters, many assessees, they are under a mistaken impression. They will say, yes, we have made necessary provisions. So necessary provisions would actually mean that they have paid that money, they have deposited that money, but they are still contesting those cases. And therefore, instead of hitting the P&L, it is appearing as a current asset in the balance sheet. So these are matters where as auditors, we need to ensure proper compliance with 501. CARO 2016, as you know, clause 7A and B gives those reporting requirements where we should be careful to see that we have complied with SA 501. And friends, this is one illustration which is given in AS 29, Accounting Standard for Provisions, Contingent Liabilities and Contingent Assets. It's a very fine example which is given as illustration 8. I've just picked up that illustration. It is a case where a company is having a pollution control issues. No, this is a case where certain people have died using the products of the company. In year one, the legal counsel says that we are confident the case will be decided in favor of the company. Year two, because of the developments which have taken place, the legal counsel comes back and tells you that no, there is a possibility of an adverse opinion coming from the courts. Now, this illustration says in year one, you need not make a provision because the legal opinion, ultimately the financial statements are based on the opinion of the management. Management opinion is supported by a legal view. And the legal view is that the case would be decided in favor of the company. So in year one, the standard says, don't make a provision, disclose it as a contingent liability. But in year two, when you believe that there could be a case going against you, then to the extent there is a probability, make a provision for the outflow of those resources. Now, friends, these provisions would certainly not be allowed as a deduction in computing the total income. But when we are auditing the general purpose financial statements, we cannot say the financial statements give true and fair view if they have not complied with the relevant accounting standards. So SA 501 gives us the responsibility and AS 29 gives the guidance as to when a provision is required to be made or not required to be made, or only contingent liabilities are required to be disclosed. Friends, the next aspect which I'm taking up is confirmations, external confirmations. Now, SA 502 does not say which cases you should take up the external confirmation, but it leaves us on the basis of risk assessment which we have done. Every standard goes back to SA 315. What is the risk assessment? What is the response to the risk assessment? What is the materiality levels which have been decided? Now, the requirement of 502 very clearly brings out that audit evidence is more reliable when it is obtained from independent sources. Second, it says audit evidence obtained directly by the auditor is more reliable than the audit evidence obtained through the auditee. And third, it says audit evidence is more reliable when it exists in documentary form. Documentary form could be in writing, it could be in an electronic method, or in any other medium. So very nicely SA 502 says, it does not say that you correspond with you take the confirmation from all debtors and creditors. It leaves to the decision and wisdom of the auditor based on what he has done in 315. Now, if we are to apply the principles of SA 502 in context of the audits of say private companies and other entities, I would say that the areas where we require external confirmations, and this is just an illustrative list, is from banks and institutions. Now, generally, friends, this is where I would like to emphasize. Banks, we don't get a direct confirmation. We get a bank confirmation letter through the auditee. That is a normal process which is accepted as a practice in the profession. But that is not what the standard says. Standard says audit evidence obtained directly by the auditor is more reliable than the audit evidence obtained through the auditee or indirectly. Now, would it mean that I should get a balance confirmation directly from the bank? Preferably, yes, that is the answer. If not, if you are not getting a direct confirmation, then we should ensure that we have done additional audit procedures to satisfy ourselves that nothing has gone wrong. We know that in the case of a very large company called Satyam, the problem was with respect to cash in hand, cash at bank. And nobody believed before that fraud which took place 10 years ago that ever in the world cash and bank balances could be disputed. That was thought to be something which is most certain and tangible. But even the bank statements were fraudulently obtained, and it was a case of a fraud. So bank confirmations, loan confirmations, then parties confirmation, I would say, If a if I have a if the auditee has a customer who is making payment on a bill to bill basis, maybe the payments are coming late, but you find that every time he is knocking off the oldest bill and making the payments. Now, if such a customer does not give you a balance confirmation, it is fine because there are additional alternate evidence with you that the earliest bills are getting settled and the outstanding is only with respect to the current invoices. And if we do audit even for the subsequent periods, we would have a better idea as to whether 31st of March balances have been realized in the subsequent periods. But if there is a customer who is making ad hoc payments, 5 lakhs, 10 lakhs he would pay, there are payments are not coming in time, payments are long overdue, reconciliations are not available, there are frequent debit notes, credit notes being raised between the party and the customer, then these are cases where it is better to have a direct confirmation. And if the confirmation is not available, then we need to see as to what kind of a provision would be required for bad and doubtful debts. Most of the private limited companies, my experience has been that they do not like to make a provision for bad and doubtful debts because it is not tax deductible. And they say if we write it off as bad debts, maybe we may lose the case when it goes to the court of law. A very possible and a very genuine difficulty which the companies have. You can't blame them. But our requirement is different. And therefore, reconciliations where reconciliations are pending, balances are not coming on a regular basis, would be areas whether it is a non-corporate entity or a corporate entity where external confirmations should be obtained for. And friends, it is quite common in many of the balance sheets to say that the balances of debtors and creditors are subject to reconciliation oblique confirmation. It is given as a note to the in the notes on accounts. And as you would agree, the notes are given by the auditee, not by the auditor. And therefore, such a hanging note does not protect the auditor in any case. And it is therefore best avoided giving such ambiguous notes in the financial statements that debtors and creditors are subject to reconciliation oblique confirmation. If they are not confirmed, if they are not reconciled, then the question is, what is the auditor doing? Is the auditor giving a qualification that adequate provision for bad and doubtful debts is not made? If that is done, at least we have discharged our duties. But these are important aspects which we need to bear in mind. Then friends, our duty with respect to compliance with the laws and regulations is well covered in SA 250. And we are not required to see all compliances under all applicable laws by the auditee. All that we are required under SA 250 is to see that if there is a material impact on the financial statements arising from non-compliance of a law, then it is properly reported in the financial statements. If it is having a material impact on the financial statements, if it is a matter which requires specific reporting to the regulator, as in case of say non-banking finance companies, then we are required to issue a report directly to the regulator. If it is requiring a specific disclosure in our companies and auditors report, then that proper disclosure needs to be made in our CARO report. So if you look at SA 250 and look at with respect to the practical applications of that, if there is an impact on the going concern concept of the company, then it requires to be reported. There is no choice. Pandemic, and if you look at the guidance which the advisories which the Accounting Standards Board and the Auditing and Assurance Standards Board have issued, going concern, they say, is one of the important aspects which March 20 audit reports we should look at. And if there is a impact of a going concern, then it requires to be reported as per SA 570. If non-compliance is so material and such that it is going to have an impact on the going concern of that entity, then SA 250 also requires it to be disclosed in the financial statements. If there is a non-compliance with the provisions of the Companies Act, And this is a situation which earlier there was a guidance that if there is a non-compliance with the provisions of the Companies Act, the auditor needs to be suitably reported in the audit report. Over a period of time, as I said, statements on qualification in auditor's report have been withdrawn. We have standards on auditing in place, and therefore we need to be guided by SA 250. So if there is a non-compliance where we are required to report as part of CARO, then of course in the appropriate clauses of CARO, we need to report on those matters. And there are matters like section 42, which is with respect to raising of share capital from the shareholders. Section 73, acceptance of deposits, both by private companies and public companies. 185, loans given. 186, investments. 188, related party transactions. 177, audit committees. 192, which deals with non-cash transactions with the directors. 197 with respect to managerial remunerations. So these are clauses which are covered in CARO. And if there is a non-compliance as a result of these clauses, or whatever is the exact reporting which is required, needs to be reported in CARO. But other than this, if there is a non-compliance, and say the company has changed its registered office, it has not intimated the registrar of companies on a timely basis, or there is a return of allotment which is required to be filed and there is a delay in filing of that return of allotment. If there is a charge to be created or a charge to be satisfied and there is a delay in the satisfaction of that charge, so we need to assess if that non-compliance is having a material impact on the financial statements. And if it is having a material impact on the financial statements, then of course even SA 250 requires us to report it in our audit report. But if it is not having a material impact on the financial statements, then SA 250 would require us to put in a letter to communicate to those charged with governance, to bring to their notice that there is a delay with respect to so many matters which the company needs to look at. Now, in case of non-banking finance companies, where there is a direct reporting required to the Reserve Bank of India, and in those matters, we need to be very careful because these are areas where the regulator, the Reserve Bank of India as a regulator, has been very strict in its compliances and time and again has been raising such matters by way of complaints to the disciplinary committee of the institute, where even in small cases there are non-compliances. A few years back, there was a situation where the Reserve Bank of India had said there was a requirement for the non-banking finance companies that before they declare dividends, a certain amount is required to be transferred to the reserves. The companies had nominal profits. Private limited companies, they had a nominal profits. They had not declared dividends, but they had not allocated a part of their accumulated profits to a separate reserve as required under the NBFC Act, as required under the RBI Act. And these are matters where complaints have gone to the institute, disciplinary proceedings have been initiated against our members. So very innocuous looking issues, but we need to ensure compliances. If we are auditing a non-banking finance companies, we need to ensure proper compliance with all the applicable regulatory guidelines. And if there are non-compliances, it is better to bring it on the audit report and also send a report to the regulator. Of course, as an advisor to the company, it is also better that upfront we help the company to ensure compliance with those requirements. But in case there is a non-compliance, then of course it needs to be suitably reported. Then friends, under the income tax laws, there are various penalty provisions. Now, is the company required to make a provision for a contravention which has taken place and for which there is a likelihood of a penalty? And if the company has not made a provision, should the auditors qualify their audit report? You should qualify Form 3CB for not making a provision in accordance with those tax laws. In my view, in general, under the Income Tax Act, penalty is on the basis of a bona fide penalty is an SSE can get out of the penalty if the SSE can demonstrate that there are bona fide and reasonable causes for non-compliance. So take the case of 48.3 or take the case of 269 SS, loans borrowed otherwise than by an account pay check exceeding 10,000 rupees. And I have one very interesting issue on that, which I'll discuss later on, as to what is, if the loans, what is the liability of a penalty in such cases. So generally, I would believe that if penalties under tax laws need not be provided for in the financial statements, but in accordance with SA 250, wherever we come across a non-compliance, we need to bring it to the notice of the directors or the partners. And if it is required to be specifically reported in the audit reports, as in case of say 269 SS, 269T, 269 ST, there of course in the form 3CD, suitable disclosures have to be made. As an auditor, one of the biggest problems which we had is that how do we give that, how do we ensure it is by account pay checks? And there are disclaimers which have been suggested in the guidance note on tax audits. So based on what the guidance note says, we need to carry out our reporting duties. So far as SA 250 is concerned, if there's a material impact on the financial statements, then the non-contravention of laws and regulations required to be reported. And friends, we should also be mindful of the fact that this concept of no-CLAR, non-compliance with laws and regulations, which is part of the International Code of Ethics, which has become applicable from 1st of July 2020. Insofar as no-CLAR is concerned, it has been deferred. The new date has not been announced by the council, but it has not been made effective as of now. But it is applicable in case of audits of listed companies. And this is a requirement over and above the requirements of SA 250. So maybe next year's audit, this is something which we will have to ensure compliance with. Now, let me touch upon certain issues in the tax audits, and then I'll come to certain other specific issues under the Companies Act. Now, friends, tax audits, as mentioned earlier, is an audit like any other audit that we do, and therefore compliance with all auditing standards is mandatory. We also have a taxation audit quality review board which has been set up by the institute, and today which calls for the audit reports issued by our members, tax audit reports issued by our members. So it is not just that having issued a tax audit report, unless it comes up for scrutiny assessment in the department, nothing can come back to us. Even through the institute's tax quality review boards, they can call for our tax audit reports, even if the department has not taken up that case for scrutiny assessments. So we need to be mindful of the fact that even for tax audits, compliance with all accounting standards, all applicable auditing standards is mandatory. Now the issue, one of the first issues which arises is SA 700 gives a format for issuing an audit opinion. And it says opinion, basis for opinion, responsibilities of management and those charged with governance for the financial statements, and auditor's responsibilities for the audit of financial statements. Form 3CB is a form issued under the income tax rules, and with online filing, the difficulty which arises is how does one ensure compliance with the requirements of SA 700? And in my view, if you look at this form 3CB, this para 3 which says, we report the following observations, comments, discrepancies, inconsistencies, if any. Because if I'm auditing a corporate entity, when I'm issuing form 3CA, I'm saying that the audit report is in the audited financial statements are enclosed herewith. And in the audited financial statements, in the audit report, I would have issued an audit report in accordance with SA 700. It is when an audit report in form 3CB is being issued, the difficulty with compliance of SA 700 could arise. And the appropriate place where one could report that is in para 3, where it says, we report the following observations, comments, discrepancies, inconsistencies, if any. And by chance, friends, if the space available here is inadequate, then even under at the end of the form in para 5, again there is a place where the information can be given, or we should attach it as a separate report and make a mention in form 3CB of the other reports and include it in the category of other reports which are attached to form 3CB. Even if it is attached as a separate report with a suitable linking in form 3CB, it is mentioned in form 3CB that other disclosures in the report which is uploaded in the other reports category, it could still meet the compliance with SA 700. Then friends, applicability of the accounting standards for tax audits is mandatory. This is an announcement which the Council of the Institute made in August 1994. So that is 26 years ago this announcement was made, and this is applicable even today, that mandatory accounting standards apply in respect of financial statements audited under section 44AB. Accordingly, members should examine compliance with the mandatory accounting standards when conducting such audits. And I believe the reason is, if you look at this form 3CB, it says here in para 4, in para 3 at the end, it says, in our opinion and to the best of our knowledge and according to information and explanations given to us, the said accounts read with notes thereon, if any, give a true and fair view in case of balance sheet and in case of profit and loss account. So whenever the financial statements are to give a true and fair view, they can give a true and fair view only if they are in compliance with the applicable accounting standards. And therefore, all accounting standards would also apply in context of tax audits. And that is how this announcement of the Council of August 1994 is applicable even today. Now, friends, accounting standard 1 says that accrual is one of the fundamental accounting assumptions. Section 145 of the Income Tax Act says that the assessee can follow cash method or accrual method of accounting. Now, if the assessee is following a cash method of accounting, the assessee is a non-corporate entity. There is no law which mandates the assessee to follow an accrual method of accounting. Then there is an announcement of an institute which says that such a method, such a position which is completely opposite the fundamental accounting assumption should be disclosed by the auditors as an emphasis of matter. And this is a note which is given in the Institute's accounting standards preface, where announcements of the councils have been given. And of course, this is much before the present standards on auditing have been issued. And therefore, this wordings of this note may have to be suitably amended. But the fact of the matter is, where we are auditing, say, lawyers, we are auditing architects, or we are auditing even of our own chartered accountants. Most of the chartered accountants also follow cash method of accounting. So there, since the fundamental accounting assumption is not being complied with, an emphasis of matter needs to be given in Form 3CB, that the assessee has chosen to follow cash method of accounting and is not following the accrual method of accounting, as is permitted to the assessee under Section 145 of the Income Tax Act. So this emphasis of matter needs to be given in Form 3CB. Then friends, we discussed this audit opinions and we discussed this types of modified opinions. Now let us look at a practical aspect with respect to income tax proceedings, where we need to apply our judgment in context of SA 705, SA 706, and decide whether a qualification is required or emphasis of matter needs to be given. Now, one of the burning issues today under the tax proceedings is whether an employee's contribution to the Provident Fund, which is received and deposited beyond the due dates under the respective acts, is it an allowable deduction or is it not an allowable deduction? Friends, as all of us are aware, under Section 224, which defines income, a contribution received from an employee for payment of his Provident Fund dues. So that contribution is received, I have to pay 10,000 rupees as salaries, I deduct 1,000 rupees as employee's contribution. So it is not an income under as per the generally accepted accounting principles. But under section 224, which defines income under the Income Tax Act, under clause 10, it is considered as an income. And the allowability of that income is governed by section 36(1)(5) of the Income Tax Act. And 36(1)(5) says that if that amount is paid before the due date prescribed under the respective acts, then it is allowed as a deduction. So Provident Fund for April 2019, which is deducted when the salary is paid on 7th of May, is required to be deposited by 15th of May 2019. If not deposited by 15th of May 2019, or the additional grace period provided under the Provident Fund Act, which is 3 days, then as per the provisions of section 36(1)(5), it is not to be allowed as a deduction. But then there has been an amendment in section 43B of the Income Tax Act. And the amendment in the section 43B says that employers' contributions can be deposited up to the due date of filing of the return of income. Now that is where the legal controversy has started. Some of the honorable high courts have held in favor of the SSE that even if the employee's contribution is deposited up to the due date of filing of the return of income, it will be allowed as a deduction. Section 43B permits it. And there are high courts, friends, where the honorable high courts have held against the SSE in favor of the department. So it's a classic case, classic issue where, say, Mumbai High Court, Bombay High Court, in the case of Ghadge Patil Transports, has held in favor of the SSE. And Gujarat High Court, in case of Gujarat State Road Transport Corporation, has held against the SSE, has held in favor of the department. Now, in such a scenario, if the SSE, and now it depends where the SSE is situated. If the SSE is in the state of Maharashtra, then the decision of Bombay High Court will prevail in the state of Maharashtra. And the SSE there can say that Bombay High Court has held in favor of the SSE, even if the department is litigating on that issue before the Supreme Court. The law as it stands today in the state of Maharashtra is, it is allowable as a deduction. Whereas an SSE is, say, in Gujarat, there the Honorable Gujarat High Court has held against the SSE in favor of the department, and even if the SSE chooses to litigate on that issue, the settled position so far as the state of Gujarat is that it is the decision is in favor of the department and against the SSE. So unless we have a decision from the Honorable Supreme Court, this is one matter, and there are several matters in the tax proceedings. This is one classic example today where different states, different positions is emerging. Now, it is not where the auditor is situated. It is where the SSE is being assessed. So if I have a client in Madhya Pradesh who is filing its returns of income in Maharashtra, the decision of Mumbai High Court will prevail, the Bombay High Court will prevail. If I have a SSE in Madhya Pradesh who is filing returns of income in Ahmedabad, the Gujarat High Court will prevail. So in such a situation, what is a tax auditor required to do? And that is where we are concerned in terms of our discussion on auditing aspects. Now, my humble view in this matter is, if I'm assessing and if I'm auditing an SSE based in Mumbai, I will issue a clean report. My report is unmodified because the decision of the Honorable Jurisdictional High Court is in favor of the SSE. What the SSE is doing is as per the law prevalent in that state. If my SSE is in Gujarat, and Gujarat SSE has a right to litigate till the time the Supreme Court comes and decides. But my audit report will be qualified. Same issue, but Gujarat High Court, I will qualify my audit report because Gujarat High Court has held against the SSE. Now I am in state of Madhya Pradesh, I am in Indore, and the Jurisdictional High Court has not given any decision on this matter. So I am lucky. I can follow the decision of the Supreme Court in case of vegetable products, which says that wherever there are different views of high courts, whichever decision is favorable to the SSE, you can follow that decision. So Indore based SSE will follow Bombay High Court decision. And in that case, as a tax auditor, I should give an emphasis of matter. So same issue, because the law is differently settled in different high courts, and applying the principles of SA 705 in Mumbai, it will be a clean report. In Gujarat, it will be a qualified report. And in other states where there is no decision of the jurisdictional high court, you can give an emphasis of matter. So this is an important matter. I'm bringing it to the notice of the assessing officer, and therefore an EOM is required to be given. So I would put this as a basis for interpreting the tax laws and giving a and deciding whether the tax auditor should, what kind of an opinion the tax auditor should give. Fortunately, as of today, Form 3CD is not asking us to give an opinion regarding the allowability of this item. It is only asking us to report and give the factual details. So the due date under the Provident Fund Act and the date on which the amount is required is deposited is all that as tax auditor we are certifying. So thankfully, we are not required to give an audit opinion on this matter. But assuming if an audit opinion is required to be given, I would put it in this position with respect to different states based on what the decision of the jurisdictional high court is in that particular state. So although we say one nation, one tax, the reality unfortunately is it is still being implemented differently in different states. And that is how the law would evolve. And whenever we have a decision of the Supreme Court or there is a legislative amendment, a specific amendment, at that point of time, there will be an outcome to this litigation. And in income tax, friends, there are several areas where there are different views. So let me take another issue. And this is where there are loans which are borrowed and repaid other than by account pay checks, but by way of accounting transactions, by way of journal entries. There is a case of worldwide township projects of Delhi High Court. This company purchased land and it asked another company to purchase land on its behalf. So worldwide township projects, in the books of worldwide township projects, land is purchased on behalf of this company by another company. So it passed a book entry, land account debit, and credited the loan account of the company which purchased the land on its behalf. Because the payment was made in cash. So instead of worldwide township projects purchasing the land, it asked another company to make the payment in cash. In its books of accounts, it passed an accounting entry, land account debit, credit to the loan account of the company which purchased the land. The issue came up is whether it is contravention of section 269 SS. And Delhi High Court has held in favor of the SSC to say that this is not a contravention of the provisions of section 269 SS. But Bombay High Court in the case of Triumph International India Limited has taken an opposite view. And it says that in a similar situations where loan was repaid by debiting the account of the payee and the loan was repaid by by way of a journal entry. Madam, some friends are raising their hands. So if you permit, I will take up all questions after 10 minutes. And then we can unmute those members and we can take up their questions.
Yes.
So Mr. Abhay Bakshi, if you can kindly give me 10 minutes more. I see you have been raising your hand. I'll come back to you. And of course, if I presume I'm audible, otherwise kindly stop me, madam, by chance if I'm not audible.
No, you continue.
So in the case of Triumph International, the court has held against the SSC. And the court has held, the Honorable High Court has held that even if it is payment by journal entries, it is a contravention of 269T. But the court has also held that whether penalty under 271E can be imposed or cannot be imposed is a separate matter. So so far as 269T is concerned, there is a contravention. Now, friends, in context of tax audits which we are doing, where we are required to report on matters of 40A3, 269S, 269T, 269ST. If the payments are made by account pay, are made not by account pay checks, but by journal entries, and your SSE is in Mumbai, then you are guided by Triumph International Limited. You will have to mention in your audit report that payments have been made by account pay checks, have been made by journal entries in contravention of 269T, because that is the decision of the Honorable Jurisdictional High Court. And for a person like me in Indore, I'm very happy that my High Court has not taken a decision. I will rely on the decision of Delhi High Court and say that as held by Honorable Delhi High Court in so and so case, payments made by journal entries have not been considered as contravention of Section 269T. So we are entitled, and this is a guidance note on tax audit under 44AB, gives us guidance on these matters. It says we can rely on the decisions of the Honorable High Courts and tribunals in coming to a view. And then if there is a jurisdictional High Court, we need to ensure compliance with that High Court's decision till such time there is a finality to that issue by way of a decision of the Honorable Supreme Court. So I just put up two instances, very striking instances and issues which confront most of us in many of the audits, where quite logically there could be payments made to suppliers by way of journal entries. Section 48(3). The guidance note gives a disclaimer that since the instrument is not available with the SSE, we have not been able to verify whether the payment is made by account pay checks or not. That is fine. But if the payment is made in cash, if the payment is made by account journal entries, then friends, we cannot take the shelter of that disclaimer under the guidance note. That is something which is auditable. The guidance note does not say that in all cases give that disclaimer and say tata goodbye to that reporting requirement. So we need to be clear that if payments have been made in cash, we need to report that. If payments are made by account pay, are made by journal entries, then depending on where the SEC is situated, we need to ensure compliance with the provisions of, with the decisions of the Honorable Jurisdictional High Courts. Then friends, there are several issues which one can take up in matters relating to tax audits and company audits. I would be running short of time. I'll just take a few issues under income tax and under Companies Act, and then my presentation would be available with Madam Mehta and the study circle. But another 5-10 minutes, I'll take my presentation and then pause for question answers. So in Form 3CD, I've already mentioned the disclosure of policies is not the disclosure of accounting policies, which is already given in the financial statements. There is a publication of Technical Guide on ICDS, which is issued by the Direct Tax Committee of the Institute. And this technical guide says that the policies required to be disclosed under ICDS 1 are the policies which are for the computation of income under the Income Tax Act. And therefore, these policies need to be certified by the SSE because these are to be followed by the SSE. These are not coming from the books of accounts which we have audited. So we need to have a MRL with respect to that. Then inclusive and exclusive method, our guidance note says it is revenue neutral. We can follow on that and bring it out. Then some important matters which I would just highlight is under Accounting Standard 9, for service contracts, AS 9 still has percentage completion method and completed contract method. As far as Accounting Standard 7 is concerned, we do not have completed contract method. We have only percentage completion method. But for service contracts under AS 9, recognizing the revenue, we still have the completed contract method. Under ICDS, now if the service contract is extending beyond a period of 90 days, then in those cases, the ICDS requires to follow the percentage completion method. So revenue will have to be accounted for as per the ICDS, though it is not booked as a revenue following the principles of AS9 in the books of accounts. Now, if you are auditing, say, the books of Sanjeev Maheshwari and Company, and I wish Sanjeev Bhaiya gives that opportunity to me someday to audit his books of accounts. Now, if Sanjeev Bhai is an auditor of, say, several listed companies, and his firm is following the service, assuming his firm is following the completed contract method under AS9. And many of us do this. We raise only one invoice to the company for all the audits we have done during the year. Now, in case of a listed company, we are doing 3 quarterly reviews, and then we are doing the year-end audit. So the audit would start in the month of July 2019 and complete after March 2020. And in such cases, if the SSE is following the completed contract method, then under ICDS, we have to ensure that because it is extending beyond 90 days, the revenue is recognized on percentage completion basis. So even for us as chartered accountants, and many of us follow the completed contract method, we need to see that for every assignment, we are raising a separate invoice. Limited review, first quarter, we issue a one invoice, limited review, second quarter, we raise a second invoice. Many of us do it, but some of us who may not be doing it, it would be important to see that there is a very vital difference between AS9 and ICDS in this regard. Then foreseeable losses are not allowed, which is one of the hallmarks of AS7. Then another important differences which apply in all cases is with respect to fixed assets. Our AS10 has been revised, friends, and the revised AS10 is also applicable in case of non-corporate entities as per a recent decision of the council, which came in last year or year before last, that it would apply even for the audit of non-corporate entities. And revised AS10 is paramateria the same as Ind AS 16. So a lot of principles have changed, and we need to be mindful that we are ensuring compliance with the revised AS10. Now the ICDS is following the old AS10, and there are very classic differences between the old AS10 and the new AS10, and therefore even between the ICDS and the revised AS10, there are significant differences which we should be very careful about. Then accounting standard 11, the general principle in AS11 is that foreign exchange differences have to be expensed off, except in case of those which are governed by para 46A of the Income Tax Act, 46A of para A of AS11, where there is an option to accumulate those foreign exchange differences and capitalize to the cost of assets. Section 43A of the Income Tax Act is on a different footing. Section 43A of the Income Tax Act says that in context of foreign exchange differences on a foreign currency loan and foreign currency loan obtained for acquiring assets outside India. So if you have imported an asset and against that imported asset you have raised a foreign currency loan, then those foreign exchange differences are required to be capitalized to the cost of the assets as and when that foreign currency loan is repaid. So significant difference between 43A and provisions of AS11. Now today, even if you do not import an asset, you are purchasing an asset within the country, you can still raise a foreign currency loan. If you are an export oriented unit, your bank will be happy to give you a foreign currency loan. In that situation, the provisions of 43A do not apply because it specifically says where assets are acquired from outside India. So those differences we need to be very careful about, and it will have impact on computation of depreciation under the books of accounts, depreciation under the Income Tax Act, and resulting differences in the deferred tax assets and liabilities. All consequential differences would arise. But the important point is difference in 43A of the Income Tax Act, which requires capitalization of foreign exchange differences at the time of payment of the loan, whereas AS11 talks about on an accrual basis on a year-to-year basis. Then borrowing cost is one standard I would suggest we should be very careful about in this pandemic period. It permits capitalization of interest, capitalization of borrowing cost, but it also provides that the capitalization should cease when there is a cessation of construction activities. Now, from 25th March to 31st of May, most of the industries were closed. So during that time period, interest on term loan as per AS 16, in my view, cannot be capitalized. It has to be expensed off. Whereas the provisions of Section 36(1)(3) of the Income Tax Act and Section 43 of the Income Tax Act and the relevant ICDS do not permit such interest to be charged to the P&L. It is not allowed as a deduction. So books of accounts, that interest will have to be debited to the P&L, whereas for the income tax purpose, that interest will have to be capitalized to the cost of asset. And during the pandemic period, I would suggest that this is one matter we need to be careful about. Then friends, tax deduction at source is a issue by itself. Uh, I don't intend to discuss all these aspects. Just one important decision which I came across recently, and I would touch upon that, is a decision of Delhi Tribunal in the case of Interglobe Aviation Limited, reported as 207 TTJ, which is a decision which is pronounced by the Honorable Tribunal in August 2020. And it says that if there are year-end provisions made for expenses, then there is a liability to deduct tax at source. Many a times, many companies, what they do is they make year-end provisions. They don't credit it to the respective party's account, they credit it to the provisions account and do not deduct tax at source. Now, in this case, the Honorable Delhi Tribunal has held, and it has in fact distinguished one of the decisions of Mumbai Tribunal. It's a very fine decision. I would suggest you to read, and that's why I've given that citation. It says if the year-end provisions are ascertainable, and you know which party how much amount is to be paid, then you are required to deduct tax at source. And if you do not know to which party how much amount you have to pay, then it says it is an unascertained liability. On the latter part, one can debate. I would most respectfully say that even in that case, there could be a case made out that it is not an unascertained liability. But the Honorable Tribunal has held that if the year-end provisions, if they are not specifically identified to parties, then it could be a case of an unascertained liability, and then there is no question of deduction of that. So for year-end provisions, one needs to be careful about this decision, because many a times SECs do not deduct tax at source on year-end provisions. Account pay checks I have already discussed. Let me just touch upon some of the important matters under the Companies Act. Books of accounts is defined in section 2 subsection 13 of the Companies Act, and it says it includes records maintained. Now it's an inclusive definition, and it says books of accounts include records maintained in respect of all sums of money received and expended, all sales and purchases and goods and services by the company, and all assets and liabilities. So even a fixed assets register is part of the books of accounts. Whether inventory records are part of books of accounts would depend on facts of each case. Whether it is possible to maintain it depending on the types of inventories which are there, so on and so forth, type of business of the SEC. But fixed assets register, reading this definition, one would conclude that if the physical assets, if the assets are material to the size of the balance sheet, then even a fixed assets register could be a part of books of accounts as defined here. Then 143(1) talks about 6 matters where an inquiry is required to be made, and reporting is not mandatory. Reporting is if you come across anything in your inquiry, but inquiry is required to be carried out. And clause B is very important. 143 subsection 1 clause B, and this was also there in 227 1A earlier. Whether transactions of the company are represented merely by book entries are prejudicial to the interest of the company. Now, friends, for various reasons, there are companies which buy goods and sells goods only by way of invoices. Now, I need not go into those details. We are all well aware of companies which have been booking turnovers by just rotating the invoices between a group of companies. The responsibility of the auditor is there to see whether transactions which are represented merely by book entries are prejudicial to the interest of the company. It may not be prejudicial to the interest of the management of the company which is doing those transactions, but certainly it could be prejudicial to the interest of the company. And that is where, as auditors, we need to be careful of what is our reporting requirement. Then 143(3)(f) and H are two clauses which are important. And there is a very fine guidance note which was earlier there in context of 227, again brought out in terms of 143(3)(f) and H. Uh, I would request members to look into this guidance note. It gives a very fine examples when reporting is required under this 143(3)(f) and H. And to give you an example here, if there is a material weakness. Now, 143(3)(h) says any qualification, reservation, or adverse remark relating to maintenance and other maintenance of books of accounts and other matters connected therewith. Now, if there is a qualification with respect to 143(3)(i) of internal financial controls relating to financial reporting, it could also require a separate reporting under 143(3)(h). And there are very fine examples given in this guidance note, which one needs to bear in mind. Then friends, section 42 of the Companies Act is very important. It applies even to private limited companies. So raising further shares from the existing shareholders would also require compliance with section 62 and section 42. These are provisions where we are required to report under CARO. So share application cannot be received in cash. Share application has to be received by checks, demand drafts, or other banking channels. If it is received in cash, if it is not deposited in a separate bank account, if it is not allotted within a period of 60 days, then we need to suitably report in CARO for non-compliance of section 42. And invariably in case of private companies, it is found that section 42 is not properly complied with. Even in case of government companies, it is seen that government, it is 100% government company. State government is the 100% shareholder. And it says, I have given you loans, so out of that loans, you convert them into share capital. And companies would be transferring at the year end money from loan account to share capital account. But that would not be in compliance with section 42. And we have a specific reporting requirement under CARO. Then acceptance of deposits is one of the very key areas for audit of private companies to ensure that it has not accepted deposits. Whatever deposit it has taken from directors or shareholders, there is a requirement that there should be a declaration from the director or the shareholder that it is his own sources and not from borrowed money that he has given loans to the company. If a director has borrowed money and given that loan to the company, it is not falling within the exemptions given in the company's acceptance of deposit rules. Now, many a times this declaration is not available with the private companies. So we need to ensure that there is a proper declaration from the director, which is available with the company, that loans have been given by the directors out of their own funds and not from borrowed funds. Now, one important difficulty which many of us could have is if we are also the income tax consultant and client, not only for that company, but also for the director. And as auditor, we are auditing the company, whereas as tax advisor, we are aware that the director has borrowed money and deposited the money in the company. Now there, friends, guided by our code of ethics, we cannot even accept a declaration from the director to say that he has given the money out of his borrowed from his own sources, because otherwise we are aware, as an individual, we are aware that that declaration is not matching with the records and other details of that director. So these are areas where, because many of us are providing multiple services to the same clients, we need to be careful about our duties as auditors. And wherever there is a conflict between the role of a director and role of a consultant, we should give more emphasis to the role of auditor than to the role of consultant. So I think I'll pause here. There are a few more slides which would be available with the members. But sir, I think we can take up your questions at this point of time.
Yes, sir. I'll just share the question screen. It is visible to you now.
Yes, sir.
Yeah. So first is a general question. You can skip it or as you wish. And second one, in the clause 27A of the form 3CD, is it compulsory for ITC under GST? What details should be filled in as availed ITC and utilized ITC in the and balance?
Now, while all questions are important, pardon me if some of the questions I'm unable to respond, but this issue on clause 27 is a very relevant issue. I would only say that there is no guidance note available to us as of today, which is dealing with this matter. The guidance note on tax audit issued by the institute is prior to 2017. I have not seen the guidance note after 2017 when GST was introduced. So on this issue, there are divergent practices being followed. Many members say that what is required is SENVAT credit, so why should I report it? Whereas I would believe personally that now that GST has replaced SENVAT, it is better to report what is with respect to GST.
Yes, sir. And actually, in the last year, 2019, they've added the word ITC. So
Yeah.
when ITC used, I think by default we cover the GST also. Now, next
Yes.
question, sir.
Yes, I fully agree with you, sir.
This is a special request to you. It's written, can we get a model draft of company statutory audit and tax audit with disclaimers in view of COVID-19 situation?
So I would suggest it's available on the institute's website. There is that Auditing and Assurance Standard Board has come out with very fine advisories specifically with respect to going concerns under COVID-19. And I would suggest you refer to that. It's a very good, very informative, and they have covered several practical case studies under COVID-19 with respect to going concern.
Thank you, sir. We'll refer that. Now, sir, this is one practical problem everybody is following, sir. But when received under 143(1) from CPC, they disallowed PF ESSC paid late. Then
So professional development work for us. CPC is following their policies. So CPC says because the department is in litigation, they are referring the matter to the jurisdictional assessing officer. And once it comes to the jurisdictional AO, you go and tell them, show them the decision of Bombay High Court. The AO will give you that deduction. They may go in appeal and because they are litigating on that issue, but there will be no tax demand. If the assessee is in Gujarat, then he has to pay the tax.
yes,
You
sir.
won't get a stay.
Now with all the faceless assessment and faceless appeals, I don't know when finally we'll get the relief. Yes. Sir, next.
But faceless is a good step in a very good step, I would say.
Sir, we'll have a separate discussion on that. Sir, the next question is, chartered accountants receive funds from clients to pay their TDS or GST or income tax, whether provision of 269 SS will apply.
I don't think 269 SS should apply in that context.
It is repayment other than by check.
It is, but if we are keeping this money for a longer period of time with us, then our code of ethics requires us to have a separate designated bank account. It should not be mingled up with our regular banking account. But if you have received a payment and you have immediately made the online payment, then I don't think there is any issue in that.
This a private limited company dealing in shares and future and option in stock exchange. Kindly explain applicability of the NBS clause qualification in CARO.
So NBFC is well defined as per the provisions of the RBI Act. And if it is having more than 50% of its assets or income by way of financial assets or financial income, it comes under the definition of NBFC. Many a times it is less than 50% and therefore it goes out of the definition of NBFC. So those clauses you need to see whether it is applicable to you or not. And if it is a NBFC, then that CARO reporting requirement would also come into place.
The next question is, in case of loan repayment, if the company has made third-party payments such as personal credit card payment on behalf of directors, is it required to be reported as violation of 269T?
Yes, because 269T specifically requires you to repay the money to the person from whom the loan is borrowed. If you look at the wordings of 48.3, it says that payment is to be made by account pay check. Now, suppose I have to make payment to Mr. Bhatt and Mr. Bhatt says on my behalf, pay it to Madam Mehta. So far as I have made a payment by account pay check, that it meets the requirements of 48.3. But if I had to repay a deposit to Mr. Bhatt, I cannot repay it to anyone else other than Mr. Bhatt because 269T is very specific in terms of that. So as a tax auditor, we need to report. Whether there is a penalty or no penalty is a separate matter. Our job is to ensure that if we are aware that the payment is made to another person, many times it may not come to your notice because to whom the payment has finally been made may not be, you may not come to know from the books of accounts and vouchers available to you.
This is one thing actually generally we do not follow up to the T. I think after hearing you, I think we'll follow that. And now, sir, normal question. Ind AS does not
No,
allow.
my personal view, sir. I mean, I could also, there could be different views on the subject. It is my view. So I don't say that you need to really follow that, but it's a view which you need to consider.
I said the view comes from your vast experience and exposure, so we'll definitely consider that.
I would suggest it is also what is given in the guidance note. So whatever is given in the guidance note, we should follow religiously.
Yes, sir. The next question is, Ind AS does not allow percentage completion method, but it says that revenue should be recognized when the control is passed to the customer, which in case of construction contract is on possession. But in case of real estate developers, if it is not practical to comply with Ind AS, that's what should be done.
Now, Ind AS 115 permits percentage completion method subject to para 35, which para 35 of Ind AS 115, which has given certain conditions. Now, one of the condition which many of the builders are not able to follow is, one of the condition under 115 is that you should have a legal right to recover the money which you have recognized as revenue. So suppose you have recognized 60% of the revenue. You say 60% of the flat is completed and 60% of the revenue is to be accounted for. Say the flat is costing 1 crore, so 60 lakhs you recognize. Now the contract with the customer is that if the customer cancels the contract, you cannot forfeit more than say 5% or 10%. So the situation that arises is you have recognized 60 lakhs as income, as revenue, but if the customer cancels that contract, you are entitled to only say 10 lakhs of rupees. So Ind AS 115 has brought in an additional condition which was not there earlier in our guidance note with respect to real estate transactions. Our guidance note had 3 conditions: that 25% of the construction activity should be completed, all necessary permissions should have been received, 10% of the sellable area should have been sold, and contract should have been executed, and 10% of the money should have been realized. So these were the conditions. In a way, there is now one more condition, that you should have a right to receive the money which you are recognizing as revenue, which is brought in by Ind AS 115. And that is where people have difficulty in complying with 115. It is not that 115 does not permit you to follow percentage completion method. There has been suitable guidance which has come out from our institute, our Ind AS. In fact, Sanjeev Maheshwari ji, as chairman of the ASB, is the person who is credited with founding this Ind AS transition facilitation groups. Sanjeev bhai, that ITFG is doing a wonderful job. It has brought out so many bulletins and given so much of clarity to Ind AS, which Sanjeev bhai had started as chairman of the ASB. So a lot of guidance is available when you can apply percentage completion method even under 115.